So good afternoon, folks, and welcome to the first Rising Giants open house. We did a CCP open house last year. It was a marathon affair. I remember it was 4 hours. So let's see how long the Rising Giants open house continues. I'll kick things off, and then I'll hand over to Ashvin Shetty, our fund manager, and he's joined today by the various fund managers and sector analysts who actually are the experts on the various stocks inside the Rising Giants portfolio. So we've got a packed agenda. So let me move quickly. Some of you are perhaps new to the construct, so we will spend around 5-6 minutes just laying out the Rising Giants construct before we get into the core of the portfolio and how the compounding in the portfolio works. Right, so just to lay the background picture quickly, right? Remember what we have said over the last 3 years in Marcellus's evolution. We said that in the last decade or so, the Indian economy has been altered. It's been structurally altered. 3 sets of changes have played out. First off, the country has got networked, right? So the doubling of national highway length, the 54 growth in broadband usage, the pentupling in airline traffic over the past decade, GST, UPI, the country has been joined up. As you've joined up the nation, as we have joined up this economy, which was hitherto fragmented, as we have joined it up, regional franchises have got squashed, regional franchises have got squeezed, and national giants are emerging, right? In the CCP portfolio, we can see, for example, the rise of Titan, the relentless rise of Tanishq and Titan at the expense of the local jeweler. That's the CCP construct. In Rising Giants, you can see the relentless rise of Dr. Lal Path Labs at the expense of the local compounder, right? And this is a trend that you see in country after country. Formalization and economic integration means the demise of the small regional player and the rise of national giants, and that's a critical theme in Rising Giants. The second theme that's characterized India over the last decade is the rise of low-cost world-class technology, right? Truth be told, India doesn't get any credit for the low-cost world-class technology. It's not as if we created it, but we are huge beneficiaries, right? The rise of cloud, mobile, and SaaS, the rise of cloud, mobile, and SaaS is allowing small, well-run companies to grow faster than they ever did at lower cost, right? So again, using Dr. Lal's success is underpinned by the use of SAP, an enterprise resource planning tool that's underpinned their crushing of the working capital cycle. They operate on a zero working capital cycle. The rise of the home collection model in the Dr. Lal in the Path Lab industry, again another use of technology. So even when it was $1 billion market cap company, Dr. Lal was using the sort of technology which, say, an Asian Paints 20 years ago was only able to use when it was a much bigger company. So whether it is little Marcellus or the fast-growing business at Dr. Lal or at Page Industries, low-cost, world-class technology has become a potent driver of rapid growth in the footprint, in the revenue footprint of well-run small and mid-cap companies. And these two factors are interplaying, right? The integration of the country, the creation of a giant integrated economy, and the rise of low-cost world-class tech, it's interplaying very effectively. Had the country integrated without the tech, we wouldn't have enjoyed the rapid compounding we are seeing in small and mid-cap companies. And had the tech piece happened, had mobile cloud and SaaS happened without the national integration, it wouldn't have been so much fun. But what's very powerful, what's very encouraging is these two things have happened together. And it's, as they say, it takes two to tango. And we've got two very powerful effects resonating with each other, thus creating rapid compounding, right? And just to give you a sense of the scale of compounding, right, we've used this slide before, but just to sort of set the context for those who are new to the Rising Giants construct, if you take a typical CCP franchise, right, so CCP franchises are companies that even 20 years ago were market leaders, say an Asian Paints, say a Nestle, say a Titan, right? So if you take the typical CCP franchises, and those of you who are CCP clients, 40,000 crores, around $4 billion, I would say, would be a typical Rising Giant. So 30,000 crores, not 40,000, sorry. 30,000 crores would be the typical Rising Giants franchise market cap. Their compounding is closer to 30 closer to 35% than to 25%. And these franchises, and you can see these companies, right? You can see 20 years ago, these companies barely existed. The Rising Giants franchises, in a way, are a children of this age of integration and low-cost world-class technologies, even more so than, say, a Nestle or a Asian Paints. The Rising Giants franchises intuitively are logged into, are integrated with the low-cost world-class technology paradigm, and that enables them, as Ashwin will show you, that enables them to generate exponential growth in cash flows, and that's going to be a central theme of investing in the Rising Giants paradigm, right? As ever with Marcellus, all of our portfolios highly concentrated, 15 stocks. Top 4 stocks will carry 40%, top 10 stocks will carry 70-80% of the portfolio. And as ever with all our portfolios, clean accounts, step 1, good capital allocation, step 2, and very powerful comparative advantages, step 3. But all of that in the context of Rising Giants gives you access to a faster stream of compounding, because these companies are smaller, their free cash flows are compounding at 30-35%. Now, how exactly does it work? Why do companies in the Rising Giants, how are they able to generate this extra compounding? Ashvin Shetty has created a very interesting set of slides for you guys to look at. Over to you, Ashvin.
Yeah, thank you, Saurabh. Good evening, ladies and gentlemen. I hope all of you are doing well. So let me share my screen. So this is, I'll first cover how the Rising Giants portfolio is constructed. Many of you must have seen this before, but for the benefit of persons joining in a RG webinar for the first time. So broadly, there are 450 companies in the RG universe. So that is $0.5 billion to $10 billion market cap companies. And our objective is to find 15 companies out of that. So how we go about shortlisting 15 companies from a set of 450 companies is through this investment process. So broadly, our investment process is divided into 2 parts. So one is we employ a couple of quantitative screeners. And these quant screeners actually help us narrow down the list, eliminate the starting list by more than 90%. And that remaining 10% basically forms the research, basically the bottom-up research universe for our analyst. So the first quant screen which we employ in line with what Saurabh said, we are looking for clean companies. So in that order, we use the forensic accounting screener. This is nothing but a set of 12 accounting ratios which we use to rank the companies on their accounting quality. For example, one of the most common ratio which we use is how much of the operating profits are getting converted into operating cash, because we believe it's relatively easy to manipulate the operating profits, but very difficult to manipulate the cash, right? So as a result, our model punishes companies where the operating cash is significantly lower compared to the operating profit. So we use last 6 years of financials for the forensic screen. So that is example of one ratio. Similarly, we have 11 other ratios, and in total 12 ratios. We calculate the score of these 450 companies across these 12 ratios, rank them on decile basis, D1 being the best and D10 being the worst. And the bottom 40% companies, that is D7 to D10, we eliminate those companies because our forensic screen is saying that prima facie there are red flags surrounding the reported numbers of those companies. So 40% of the companies get eliminated at the forensic screen level. We have 200 to 50 companies. Now our objective is to find companies which are dominant, generating very healthy ROC. They are investing back that capital into the business and also generating healthy return on the reinvested capital. So to find those companies, we use again 6 years of financials. We use 4 ratios. We calculate what is the improvement in revenue growth, operating margin, fixed assets turnover, and working capital days over the last 6 years for these 200 to 50 companies. And we select companies which score, we have a percentile ranking for each companies on these 4 ratios. And we select companies which score more than 50% on each of these 4 ratios. Suppose a company scores very well on revenue growth, but it is faltering on the working capital front, that company wouldn't get selected by this model. So this is quite a stringent model. You'll be surprised to know that only out of these 200 to 50 companies, only 35 to 40 companies kind of make this cross this threshold. And these 35 companies, or rather 40 companies, which pass through both our quant screen, they form our bottom-up research coverage. So our analysts basically do 2 broad work on the research front. One is, we do a lot of secondary research, typically reading at least 15-20 years of the annual report. Reading 15-20 years of the annual report help us develop the picture, the evolution of the company, what were the crisis point in the past, how did the management deal with those crisis point in the past, and it helps us build a good picture about the business model, the evolution, the mental makeup of the promoters, management. And more importantly, we do a lot of primary data research. So typically we endeavor to speak to at least 10 to 15 people in the industry, besides meeting the management, but more importantly, meeting people in the industry who can give us independent insights into this company. So typically customers, ex-employees, vendors, competitors. And for small and mid caps, it is a very time consuming process. Typically it takes months and months on end, even years actually for that matter, to get to speak to 10 to 15 good quality primary data, meet them, get insights from them. And basis this both annual report reading, secondary research, and primary data research, we used our longevity framework. And we select companies which we think will compound the fastest and compound the longest in our framework. So I'll cover that as part of presentation later on, the longevity framework. But basis this framework, longevity framework, the best 15 companies out of the 35-40 companies, they actually make it to the actual portfolio. So this is how we have constructed the Rising Giants portfolio. Currently, we have 15 names in the portfolio. We have 99% allocation to the equity, 1% in cash. And going into the kind of the crux of the today's presentation, we are focusing on the free cash flow compounding for the Rising Giants portfolio. So my colleague Rakshit, who is there on the call, has actually explained the concept of free cash flow, why free cash flow is more important than looking at the earnings growth in the November webinar. So I will not go into the concept of the free cash flow compounding. The presentation today is more from how we are seeing the free cash flow compounding for the Rising Giants portfolio, and what gives us confidence that that free cash flow compounding will sustain for a number of years. But before we get into that, free cash flow, basically, very simply put, it is, there are three parts to the free cash flow. One is how much of the operating profit that is generated by the company, and how much of this operating profit is reinvested back. So primarily under reinvestment, there are two things. One is working capital, and one is the fixed assets. And obviously fixed assets, it also includes intangibles. But there are three elements: operating profits, working capital, and fixed assets. And how, it's not easy actually. No company starts generating free cash flow from day one. So it is a very difficult part to get to, one, the positive free cash flow, and then compound it. So what we are trying to explain in this chart is the journey to free cash flow compounding. So all the companies typically, unless it is a superstar company, all companies typically start at a nascent phase, right? When there is no business. But at the same time, they have to employ people, they have to incur cost, they have to build inventory in anticipation of the sales. Similarly, they have to build factories. So as a result, the operating profit at the nascent stage level is non-existent. But at the same time, there is investment that is required for working capital. There is investment that is required to fund the fixed assets. So as a result, at the starting phase of any company, all these three parameters are adverse from a free cash flow perspective. So there are no non-existent operating profit. At the same time, reinvestment is very high. So as a result, the free cash flow tends to be negative, deep negative at this stage of the companies, which is the first actually you'll find in this chart. But most of the companies actually, they kind of get stuck in this phase itself actually. So most of the companies, at least in India, you'll find many companies who never generate actually positive free cash flow. They have been in existence for year and year, but you'll never find them generating positive free cash flow. This could be either because this company ka business model mein kuch issue hai, the unit economics is doesn't work for these companies, or it could be also a case of corporate governance issue. The company may be generating cash, but most of this cash could be siphoning off by the promoters. But the point I'm trying to make is that most of the companies will actually be perennially free cash flow negative. A small set of companies actually cross this stage and they enter the growth phase. Growth phase, there are two phases again within the growth phase. One is the early growth phase. These are typically companies, which have now they have a competitive advantages. They are finding traction in their product. So what we'll find that the operating profits of this, the revenues of these companies will start scaling up, and the revenue will start outgrowing the cost. And as a result, the company will benefit from the operating leverage. In other words, the operating profits will start growing for these companies. But the problem is that the size of the operating profit, the absolute size of the operating profit will be still very low. And while the company is growing, they need to actually reinvest in the working capital. They have to build factories. So as a result, while the operating profit is growing, but free cash flow में वो convert नहीं होता है, because they have to build inventory, they have to give credit terms because they are still small companies. They don't have the bargaining power vis-a-vis their customers or vendors. So as a result, they have to give credit terms, good credit terms to their customers. They are not able to extract good credit terms from their vendors, and they have to build capacities, keep on reinvesting. So as a result, you'll find that the operating profit for these companies, will be generating good ROC, but free cash flow will be patchy. एक साल में बहुत अच्छा free cash flow रहेगा, but there will be a capex, which will kind of result in huge negative free cash flow. So it will be patchy free cash flow. But great once, as these companies continue to do well, they cross the critical threshold of free cash flow generation. So operating profits will typically operating profits will cross size where it more than makes up for the working capital requirement, it more than makes up for the capex requirement. And this is the stage, actually you'll find the bent over here. This is the stage where there will be an exponential growth in the free cash flow. And also what helps in this stage is that because the company is has typically become a market leader, it has typically become a dominant player. As a result, there is also a rewinding of the working capital days. So customer ko debtor days jo pehle deta tha jab small tha, will start cutting down on the credit terms credit days that you give to the customer. Similarly, it now tries to extract better credit terms from the vendors. So working capital, which was hitherto a drain on the free cash flow, it actually starts positively contributing to the free cash flow. And this is where, rising giants, actually, most of the rising giants will show it in the hard numbers in the next slide. But this is where the rising giants actually are currently. So the last 5 years, and more particularly in the last 3 years, we are seeing exponential growth in the free cash flow generation of the rising giants, And this is the sweetest spot in the free cash flow. The reason is that, again, there are only out of these companies which are in this sweet spot, majority of the companies are not able to sustain here actually. So they actually go into the next phase. Mature ho jata hai free cash flow and it starts declining. Again, the reason is that, because you actually kind of hit the growth ceiling in terms of the addressable market share, or the company may become complacent, etc. So as a result, again, most of the companies in this phase, they quickly go into mature and subsequently the decline phase. So we are interested in our portfolio in having companies which not only are in this phase, but where they will continue to be in this phase for a long period of time. And we will explain in the coming slides why we are confident about the rising giants will continue in this phase of exponential free cash flow generation for years and years to come. So this is kind of the crux of this chart.
So Ashwin, if I may, I'll just quickly summarize. So folks, what Ashwin is getting at is free cash flow is nothing but profits minus reinvestment. So if you really want to simplify it, free cash flow is profits minus reinvestment. With fast-growing companies, as they cross a certain scale, in Ashwin's case, in the growth phase, that where the yellow line kinks, when they cross a certain scale, the reinvestment requirement, right? The reinvestment requirement starts diminishing because profits are continuing to grow, right? Because free cash flow is profits minus reinvestment, profits are going up, reinvestment is going down, your free cash flow blasts through the ceiling. And as a result, you'll see something that else that Rakshit has discussed in his previous webinars. The slope of the yellow line, the slope of the free cash flow line is steeper than the slope of the profit line, which means what? Which means that the free cash flow is growing much faster than profits. The free cash flow is growing much faster than profits. And for high quality growth oriented companies, this is a distinctive feature. High quality growth oriented companies ka free cash flow will grow faster than profits. And therefore, one of the takeaways from this is never ever look at PE multiples. The E in the PE drives nothing. It's the free cash flow growth which drives valuation. And for high quality growth oriented companies, free cash flows will grow faster than profits. Why? Because as they grow bigger, as Ashwin explained, they squeeze the working capital. They tell their clients, fatafat paise do, pay me rapidly. They tell their suppliers, I will pay you later. So they squeeze their working capital, they sweat their factory harder, they reduce the working capital and the fixed asset toll, the reinvestment, the gray bars reduce, profits keep rocketing up. You and I get exponential free cash flow growth, right? That is the core, if you ask us, of growth investing का core secret आपके सामने screen पे है. Ashwin, back to you.
Yeah. So this is actually how the numbers, the hard numbers for the stock, what we discussed in the earlier slide. This is how actually the numbers look. So like if you can see, I've broken down this period into three parts. One is FY12 to 15, then there is FY15 to 18 and FY18 to 21. You'll find that in FY12 to 15, these companies were already doing well actually on the operating profit, which is EBITDA. If you look at the median growth for the portfolio, EBITDA has grown as a very nice, compounded nicely at 25% over FY12 to 15. Similarly, the ROC for the companies is also very healthy at around 24%. Where actually, the problem was the operating profit or the EBITDA was not getting fully reflected or converted into the the operating cash flow, and second, the free cash flow. And this is the precise reason, which I explained in the previous slide. These companies were in early growth phase. While the growth of the operating profit was good, but the size of the operating profit was still small actually, and they couldn't fully cover the reinvestment part. But things started changing from FY15 onwards. And if you see at the this kind of a block of 3 years, you'll find that, not only is operating profit sustained at a very healthy level, in fact, the growth in the operating cash flow, 26%, is higher than the operating profit. And there is also a slightly higher growth in the free cash flow compounding. And this is where, these companies, say 6 years back, they started hitting that kind of the scale level, where operating profit started outgrowing significantly the working capital. And this has actually only accelerated in the last 3 years. You'll find that FY18, say 21 May, while the operating profit is similar to FY15 to 18, but the gap between operating profit and operating cash flow has significantly increased. So operating cash flow has compounded at 33% between 18 to 21. And similarly, the gap between free cash flow and the operating cash, that is again expanded from earlier. It was only 3 percentage points in FY15 to 18. Now the gap between operating cash flow and and the free cash flow, that has expanded by nearly 8 percentage points. So this is how this is actually in actual numbers, what we were saying about the Rising Giants portfolio. And this has happened actually amidst the slowdown and the pandemic that we have seen in the last 3 years. The free cash flow profile of the Rising Giants has only strengthened significantly in the last 3 years. And now we'll get into what are the key drivers. Actually, in a way, Saurabh actually covered this in the beginning. So what has happened is that, what has aided this strong free cash flow compounding in the last decade or so, or rather 6 years or so, is I'll just summarize what Saurabh said. One is, the networking of the Indian economy. So road has basically, why historically the unorganized segment or the regional players thrived in India, because there were barriers actually. There was no connectivity actually, smallest of the remotest of the town. The big players couldn't enter. There was no road. But that the road has improved significantly. Similarly, the internet penetration has also improved significantly. So as a result, now even the bigger players are able to reach the nook and the corner of the Indian remotest of the Indian area. And as a result, while earlier the regional players, the unorganized segments were protected by that barriers, now that has got broken. And this has been one of the important developments. Similarly, disruption and slowdown, that has only, played it in the favor of the stronger companies like Rising Giants with strong balance sheet, etc. This slowdown disruption has actually worked and helped them consolidate that market share. And the result of both these things is that there has been a heavy market share gain in favor of these strong companies like Rising Giants in the last decade, and more prominently in the last 3 and last 6 years. Another development has been the low-cost technology access. So earlier, again, 15, 20, 25 years back, when we talk about technology, it was all about hardware. It was about supercomputers and so on. So it was kind of a very restricted space, restricted to probably the Fortune 500 companies. But over the years, technology has become more accessible as it has migrated to cloud, SaaS, etc. It has become more and more modular, and as a result, it has become very, very affordable to the companies which have the right mindset. You obviously there is also you need to have financial resources, but you should also have the mindset to adopt the technology. Rising giants have been among the companies which have adopted technology, and we will come to some examples later on. But they have been at the forefront of adopting technology across various facets of the business, whether it is front end, capturing customer data, or even at the back end, basically, how to optimize the inventory level, how to do a better job on the production planning level. And as a result, the use of technology has both, helped on the margin side in terms of making the operations better, or even growing the revenue pie. And more importantly, it has helped on the working capital front also. So we'll find that, the working capital days of most of these companies have come down significantly in the last 3 years. And third is the capital initiatives, capital allocation initiatives. Again, we will cover it in a little bit more detail in the coming slides. But these companies have been very smart about using their capital allocation to build new growth drivers. So as it is, the combination of all these things have, despite one of the, I would say, the last 6 years, and more particularly the last 3 years, have been one of the toughest periods from a macro perspective, right? So even in spite of this very tough macro environment, these companies have been able to generate healthy operating profit of 17%, which is nothing but a culmination of the market share gains, the efficiency in the operations, working capital, and because these companies have used their capital very, very smartly. And also it is reflected in the working capital days. For example, the median portfolio working capital days at FY18 end was around 65 days. It has come down to 55 days in the last 3 years, and which is roughly 15%. And as a result, in the earlier side, there is a gap of 17 and 33%. That is fully explained by these working capital days, which have come down significantly. And also, besides technology, there is one factor again, which I covered in the first slide. As the companies get more dominant, they get more leverage to bring down the working capital days. That market share gain, whilst that helped on the profit and loss front, but it also has a second order impact on bringing down the working capital days. And as a result of this healthy operating profit plus the reduction in the working capital days, which has actually driven the operating cash CAGR of 33%. So in a summary, this is both a set of changes happening at the macro level, and because these companies have been very smart to exploit these changes, this has resulted into a strong healthy.
Ashvin, let's remind people, in the November CCP webinar, Rakshit made exactly the same point about CCP companies. He showed you that for CCP companies over the last decade or so, profit compounding had been 16-17%. But free cash flow compounding was 25%, right? CCP compounding, big gap. Profit compounding 15-16, free cash flow compounding 25. Here Ashvin is showing you rising giants companies, profit compounding 17, free cash flow compounding 33. And that's why I stress again, folks, don't look at profit compounding, don't look at PE multiples, look at free cash flow compounding. That is the measure of a class company. Unfortunately, as Ashvin has said, as Rakshit has said, unfortunately, most companies in India, free cash flow hi nahi banta, forget about free cash flow compounding. Ashvin, back to you.
Yeah. And this is how, the reinvestment has actually helped these companies again in the last, the last point, capital allocation. So sorry, I will go step by step. So one is that with these companies have continued to, one beauty of this portfolio rising giants, or for that matter, any of our actually stocks in any of our portfolios, the reinvestment rate has been pretty high. It's not that, the absolute reinvestment has come down, that has contributed to the free cash flow. The absolute reinvestment of these companies continue to be very high. Only the relative, the reinvestment as a percentage relative to the operating profit, that has actually been coming down, which has actually helped the free cash flow. So just wanted to emphasize that there is no cut down in the absolute value of the reinvestment. In fact, if I have to give some number, the reinvestment in absolute terms has only increased by 25% over the last 3 years at the portfolio median level. And this has been one of the success factors why these companies have done well in the last 3 to 6 years. So one is that these companies, again, will when we cover these stock specific slides, we will come to specific examples. But these companies have continued to put money into capacities and expanding their distribution network. these companies have continued to target, going into new product adjacencies. Again, we'll cover the examples, new products. But more importantly, there is also incrementally new investments these companies have made into technology in acquisition actually. And this has actually opened up in the last 3 years because of the challenges that we've seen in the last 3 to 6 years. Many small companies are simply not able to sustain their businesses. And the rising giants portfolio companies have been very, very proactive in lapping up these companies. And there has been an accelerated pace regarding acquisition in the last 3 years. And finally, which has made a difference, particularly in the last few years, is the accelerated investment in tech, again, which we covered actually in the previous slides. So 10 साल पहले most of the reinvestment used to happen in building hard physical assets or growing the distribution through traditional channels. But last 5 years, more and more incremental reinvestment is happening into acquisitions and which are happening into tech space. And this kind of new investments actually has contributed significantly into growing the operating profits and working capital. And this has also played a major role in the free cash flow generation that we have seen in the last 6 years. And we will cover one live case study. So this is a company, again, a textbook case study of how, the company has evolved in terms of free cash flow generation. So again, divided into 3 parts: FY10 to 13, FY14 to 17, and FY18 to 21, where really the Astral's free cash flow has taken off significantly. So if you look at Astral, actually, 15-20 years back, it was actually a company on the verge of bankruptcy. And this company, actually, we have written it extensively in our in the Unusual Billionaires. You will find that, a topic dedicated to Astral in the Unusual Billionaires. But 20 years back, the company was on the verge of bankruptcy. But through smart product innovations, to smart go-to-market strategy, the company started building traction for its CPVC pipe segment. And during FY10 to 13 period, the company was finding traction for its CPVC segment. It was started to getting adopted by more and more customers. And as a result, the operating profit of the company, which was hitherto operating loss in this period, it has started converting into operating profits. But the problem was that the CPVC was still a very small part of the overall piping industry. It was still dominated by the likes of galvanized iron pipes or normal plastic pipes. So as a result, because CPVC segment was still a small part of the overall pipe segment, there was a huge headroom for growth. And how do you target that growth? Is to grow, put new capacity. So as a result, the reinvestment was also significant in this phase of this company. In other words, the operating profit, which was roughly 70 crores per annum, it was actually getting fully reinvested into the capex, roughly 50 crores. So as a result, the free cash flow generation was quite negligible. While the operating profit was good, ROC again was very stellar, 29%, but the free cash flow was non-existent. And as company continued to gain traction more and CPVC segment continue to do well, the operating profit actually, we moved to the next phase, FY14 to 17, where the operating profit actually tripled in this. So from 70 odd crore, the operating profit per annum was close to 200 crores in FY14 to FY17 period. But again, CPVC was still in the overall scheme of pipes industry, still not very sizable. So there is scope for growth, and as a result, the investment in the capacities continued. So even in this phase of these companies, the capex was nearly doubled. Also, the company which had organically started looking at the adhesive segment in FY10, FY11, it acquired a company called Resinova. It was the second largest player in the adhesives and the sealant space. And nearly 300 crores of the operating profit was invested in acquiring these companies. Again, operating profit continued to grow, but the reinvestment rate continued to remain high. As a result, even in this phase, the company's free cash flow was not negative. But things turned significantly in FY18 to 21 periods. One is, again, the company CPVC started becoming a dominant part of the overall piping segment. As a result, the pricing power also improved significantly. So that continued to help operating profit. The Resinova acquisition also the company was able to turn around, and that also started contributing to operating profit meaningfully. And as a result, in this phase, the company's operating profit crossed the critical threshold, while the absolute amount of reinvestment, they remained same as in the previous phase. The company again, continued to invest in capacities, also acquired a company called Rex Poly Extrusion, which provides piping solution. But because the operating profit grew so significantly in this phase, it kind of more than made up for the investment that was reinvestment needs. And as a result, the free cash flow, we have seen a very fast growth in the free cash flow generation in the last 3 years. Another factor which has helped is, the working capital. Again, the same point which I made. One is that as the dominance of the company increases, the working capital, the company starts can cut down on the working capital. Similarly, the company also worked on kind of aligning the Resinova's distribution, and as a result, there was a significant drop in the receivable days in the last 2 years, and that has actually also contributed. The working capital, again, which used to be a drain in FY 14 to 17 period, it actually started contributing positively to free cash flow in the last 3 years. And basis,
just pause there 1 second. So, folks, this slide, right? If you could, you should sear it in your mind, because it will tell you the story of Indian compounding through one simple case study that Ashwin's put in front of you. So just look at the blue line. The blue bar is the operating profit. So operating profit goes from roughly 300 crores 10 years ago to roughly 1500 crores. So operating profit only grows, only in inverted commas, 5-fold. Operating profit only grows, I stress, 5-fold. The free cash flow, remember, free cash flow is nothing but profit minus reinvestment. Reinvestment can be capex, reinvestment can be working capital. Free cash flow grows from being, say, 10 crores, the yellow bar, 10 crores 10 years ago, to roughly 1000 crores. So free cash flow grows 100-fold. Operating profit grows 5-fold. Free cash flow grows 100-fold, right? And you can guess how much Astral has compounded by. You don't even need to look up the share price. Astral Poly has compounded 200 times in the last 10 years. There are people out there looking at Astral Poly ka PE multiple. When you meet them, tell them free cash flow kya hota hai, so that they understand. Show them this slide so that they understand how value is created. You can see in front of you, this is data from the annual report. Ashwin is not projecting anything. This company makes stuff that you and I use. Your and my houses will have Astral Poly ka CPVC pipes. Profit compounding 5x in 10 years. Free cash flow compounding 100x in 10 years, share price compounding 200x in 10 years. And that is why free cash flow is the main metric you and I need to track. I stress again, most companies that exist in the Indian stock market, most companies that are unlisted, don't generate free cash flow, and hence their main engine for compounding is not there. And that's why it's so important, whether you do large cap, mid cap, small cap, it's so important to lock into exponential free cash flow compounding engines, because and again, Ashwin's slide shows this beautifully. Working capital for Astral, the gray bar, went from being a drag to a generator. Working capital, see the receivable reduction that he's shown, Ashwin shown in FY 18 to 21. As working capital stopped being a drag on free cash flow, that generated the exponentiality, and we as Astral shareholders played into it, made money from it. And as Ashwin said, Unusual Billionaires 2016, we wrote about this, that this company is a money machine. Back to you, Ashwin.
Yeah, and what gives us confidence that not only for Astral, for our portfolio companies, is the things that they have done in the last 3 years, which gives us confidence that it's not just the free cash flow compounding is not just a phenomenon for the last 3 years, but it can continue in the future. And to do that, given that we have all the senior research colleagues on the line, I would request them, if you can briefly cover each and every company, maybe highlight, key things that they have done in the last 3 years. So which will, yeah. Rashid, you want to start?
Sure. So good evening, everyone. Thanks, Ashwin, for explaining it so beautifully in the last few slides. So all of these companies, as Ashwin highlighted in the table 2 slides back, all of these companies till a decade ago were compounding operating profits but till a decade ago, say Relaxo Footwear was yet to get into free cash flow positive. Over the last 10 years, they've moved from the nascent stage to the growth stage of Ashwin's chart. And particularly over the last 3 years, they've gone through that inflection point of the growth phase of Ashwin's chart, right? So I'll highlight Dr. Lal, Page, and Relaxo, and then I'll pass on to Salil for GMM and onwards. So Dr. Lal, if you really see, it has had a 15 years very consistent and healthy rate of operating profit compounding. But when it comes to reinvestment to grow the network, right, there were heavy rates of reinvestment. What has happened in the last 3 years is, first of all, it has started expanding geographies with massive investments into building infrastructure for laboratories in a hub and spoke manner, which accelerates the future growth rate, right? So they opened the Kolkata reference lab. So reference lab is a very large lab. Before the Kolkata reference lab was opened in 2018, if I'm correct, beginning 2018, they had only one reference lab, which was in Delhi, right? In a reference lab, you get all types of tests, the most smart tests as well. And the usual normal routine tests can be done in nodal labs, in you can call them regional labs or nodal labs. Dr. Lal had set up only one reference lab till 2018, right? Starting 2005 or 6 when they ventured into the pan-India network expansion. For the first 12 years, they had one reference lab. In the last 3 years, they've set up 3 more reference labs, right? So that's the rate of acceleration of capital investment initiatives that you can see in their reference lab. First 12 years, one reference lab. Last 3 years, 3 more set up. Kolkata, Bangalore, and Mumbai. The Kolkata reference lab setup has already helped them multifold. It has made the entire eastern part of the country a very big hub for servicing demand. Now samples don't need to go all the way to Delhi for high-level expensive testing. They can be locally sort of tested in the reference lab. It has increased the turnaround time through the hub and spoke supply chain massively. Increased as in improved the turnaround time, reduced the turnaround time massively for the eastern region. Eastern region has become highly successful for Dr. Lal, as a result of which Delhi NCR, right, which used to be sort of 70-80% of revenue till 5-6 years ago, is now a small minority of revenues, right? So that's the first piece of capacity expansion. The second piece is tech investments, right? Now turnaround time compression had always been the sort of competitive advantage factor for Dr. Lal in Delhi NCR, right? On top of it, they've added customer interface via various types of tech interventions, mobile app, the sort of linkage to customers' historical data of testing, and hence being able to give a more enriching experience to the customer in the longer run, right? All of that is basis tech investments that they've done in the last 3 to 5 years. And then there's a lot of automation that is being put through at the laboratory level through technology in the last 2, 3, 4 years. Acquisition is something that has always been a feature of diagnostics industries, geographical expansion. Healthcare in general as a subject is very difficult to expand geography wise in an organic manner, because the trust that you need for a healthcare customer to switch over from one vendor to another, right? The trust factor takes time to build. As a result, whether it be large hospitals, the likes of say Apollo, Fortis, etc., or whether it be small diagnostic chains, every type of business in healthcare has found it difficult to grow organically geographies over a period of time. As it is now needed for Dr. Lal to expand at a faster pace compared to how they expanded from Delhi NCR to north and north to east, right? Acquisition has to be part of the game plan, which is what they've accelerated in the last 3-4 years. Initially they did bolt-on acquisitions in West, South India, in Madhya Pradesh, Central India, etc. And then very recently they acquired Suburban. Now, this Suburban acquisition gives them a massive footprint of laboratories. There's some 45 laboratories that Suburban has, which have already got a presence, and hence there's a massive headroom that now Dr. Lal has to expand in the western areas and gain incremental market share in a new geography, right? On top of it, in their existing areas, including Delhi East, they've expanded the test menu, right? Whether it be genetics, oncopathology, etc. They are doing more and more of experimentation in areas which, if become successful, they can be massive revenue growth drivers into the future, right? This is exactly the way 5 years ago, Dr. Lal ventured into wellness, right? Through their SwasthFit packages, etc., which have now become a very large part of their, I think, 25% of all tests, and growing at a very rapid pace, right? So these initiatives are fuel for the next 3 to 5 years of growth, and hence the second half of that growth phase in Ashwin's chart, you should see flow through beautifully for this business. Page Industries, the second row here. The routine capex was already ongoing for Page. They have in-house manufacturing in a labor-intensive industry, which is actually the start of their competitive advantage. Everybody else outsources labor. Page has in-house on their payrolls the entire labor workforce, and their factories are also, as a result, their own. More recently, they've started venturing into different directions than they have in the past. One, new factory expansion is more automated, right? So their Hassan plant in Karnataka, it's a state-of-the-art automated plant, came up in the last 2-3 years, and should accelerate the asset turnover of Page Industries, and hence free cash flow generation, again at a higher pace than operating cash flow. Free cash flow generation at a higher pace than EBITDA or profits, right? So this is one piece, the automation. The second piece is they are expanding beyond Karnataka as well. It helps a little bit on the supply chain side as well, and hence also to get labor workforce from a new area. So Odisha is a place where they are opening a new plant. So those are a few new initiatives around capex that they've done in the last 2-3 years. And when it comes to technology, in the last 3 or 4 years, it's completely pivoted from a traditional business model to a more tech-oriented business model. 4 years ago, they appointed Blue Yonder, and Blue Yonder is running their supply chain efficiencies in a very, very interesting way, where their working capital cycles have been compressed in the last 3 years massively, especially around inventories. And wherever we are going to do channel checks to understand at a ground level how the business is progressing, we are seeing the benefits of Salesforce automation, they implemented something called ARS, auto replenishment system, where the distributor's inventory automatically gets replenished. And all of these are areas where working capital cycles are getting compressed further, back to the point which Ashwin made around free cash flows accelerating at a faster pace than operating profits. They haven't done acquisitions, but many new products being entered into, many new business segments, geographies being entered into. One is the whole Jockey Juniors piece, which is for kids, right? 3 years ago, they made a very successful attempt at it. Well, 10 years ago as well, they attempted unsuccessfully. Now they've got success there, and they're expanding it in a meaningful way. And the broader product portfolio in leisure wear, in particular through COVID, has seen massive traction, which is reducing their reliance on men's innerwear as a product category to drive bulk of their revenues, and making it a multi-product moated business gradually. Relaxo Footwear has again gone through a similar journey as Page, where they've invested heavily in in-house capacities and a lot of capex to fuel future growth. This firm has also done a lot of tech investment, similar to Page, the way I talked about front-end Salesforce automation, as well as automating parts of the manufacturing plant. This again is in a labor-intensive manufacturing process. In terms of new products, new geographies, there's a lot of focus on West and South in particular for Relaxo in the last few years. If you remember, 10 years ago, Relaxo was largely a North India oriented company, right? This was to begin with a flip-flop company, and then that too only in North India. Gradually now, they've found strong capabilities to acquire market share in sports shoes via Sparks in South India, in West India in their non-sport shoe segments, and a lot of investment to build sales force and a more concentrated efforts towards front-end expansion in South and West. So that's Dr. Lal, Page, and Relaxo. Salil, do you want to take over GMM?
Yeah, thanks, Akshay. Right. So, folks, GMM, as far as their India business was concerned, they were always cash flow positive in the sense that they had crossed the thresholds that Ashwin was mentioning about quite some time back. What they have done, interestingly, is that use that cash flow to grow aggressively, right? Both in adjacencies as well as in increasing their scale advantages, pushing competition out. So they acquired, first of all, the second largest, rather the only other MNC operating in India that wasn't doing so well. They acquired the dietetic manufacturing facilities to increase their grassline business. They acquired Sudarshan Chemicals, had a mixing division. Mixing division is basically another process equipment in the chemical manufacturing chain. And then they acquired for their heavy engineering business under the NCLT manufacturing facilities of Hindustan Door Oliver. So with these three, they have consolidated their scale advantages, which which are already quite dominant earlier. They used to be 50-55% of the overall glassline equipment market in India. By buying out the only other MNC, they've actually increased that dominance even further. Right. In addition to this, they've also gone in for organic expansions, almost 30-35% organic expansions at their Gujarat plant. In fact, after acquiring this dietetic facility in Hyderabad, they are going to be expanding, or they've already started capacity expansion there also. Right. So all in all, very smart use of cash flow, very smart reinvestment and capital allocation decisions, which are adding adjacencies as well as growth levers. The next talk that we have portfolio is Astral. Astral already Ashwin has given me enough details about, so I'll kind of skip that. Then we have InfoEdge. InfoEdge, very interesting company. Most of the names that we have seen so far are in a way manufacturing names, right, where you need to add manufacturing capacity. So there is a clear reinvestment that is visible on the balance sheet. In InfoEdge, that is not so evident, not so clear, right? Because all their growth and reinvestment initiatives go through the P&L, right? Because let's say for example, you want to become ever more dominant in say Naukri, which is their flagship portfolio. They want to improve, say, UX, UI, right? All those investment happen through hiring engineers, coders, program managers, and all that flows through the P&L. So not directly evident for organic growth in the balance sheet, but we see that very clearly in their P&L. So very different way of looking at it. What they've also done interesting the last 2-3 years is that in their core businesses, which is recruitment, real estate, matrimony, and education, they have made strategic acquisitions which actually make their position even more dominant than what it has always been. So, for example, they acquired IIM Jobs. IIM Jobs is a leading name for as far as BFSI and management recruitment is concerned. Naukri has always been dominating IT. Then they acquired Coding Ninja. Coding Ninja now kind of operates in the kind of convergence of training and education and recruitment, which are the three verticals that InfoEdge focuses on. They've recently acquired Zoyam, which is a SaaS platform for recruitment. So these are reinvestment growth initiatives for their core businesses. And then the third part is their venture capital investments, where what was happening to the balance sheet, now they have moved and they've seeded a $100 million dedicated fund in partnership with Temasek. So Temasek is one of the investors in that fund. InfoEdge is the manager. Right? So this gives a kind of a complete separate discipline to this VC investing bit. Right? So One is growth for core businesses, not directly visible in the PN in the balance sheet, but very clearly visible through the P&L. Strategic investments to increase dominance in core portfolio through acquisitions, and then a separate VC portfolio. So that's how these guys have smartly used their cash flow. And I remember Naukri is a huge cash cow, right? 280-300 crores of free cash every year. Then the next name, again, similar technology orientation, is Lnt Technology Services. For them, the reinvestments happen through effectively knowledge, effectively in knowledge investment. So, for example, they, in the last 1 year, last 2 years, they filed 300 plus patents, right, on their own as well as through in partnership with clients, right? Now, when an employee is filing patents, right, they are doing primary research or secondary research on companies' account, right? So again, that passes through the P&L. So that's a very interesting way of looking at reinvestments. They've also made acquisitions in areas where they have traditionally been weak, right? So you're kind of bolstering your offerings by making acquisitions. These have been largely in chip design, what we call as very large scale integration, and embedded software. So 2 acquisitions in the last 3 years. And on new product, new initiatives, they have gotten into what we can call what is traditionally understood as consulting, right? So this is a digital advisory practice. So right from being just a service provider where the client tells them what to do and they'll do it, they're now moving the next step where they are actually telling the clients what to do. And then we have Grindwell Norton. Grindwell Norton, again, a leader in abrasives and in refractories. They have been consistently adding capacities in all their product lines over the last 3 years. They're not a very acquisitive company, so no inorganic expansions as such. But from there are 2 areas specifically where we would kind of like to point out where they have used cash flows to actually accelerate growth. So one is they've started this new business called Performance Plastics in the last 5 years, which has scaled up very, very fast in the last 3 years or so. These are basically polymers which are used in very niche applications. So they've set up local manufacturing in India, which is where some of the cash investments have gone through. And second is now this Grindwell is gradually becoming a global hub for procurement by the Saint-Gobain global entities, right? So again, capacity expansions in doing this. So again, a smarter use of cash flows where you are already profitable, you are already cash flow positive, but you're using that cash to increase your dominance, which will give you faster growth in the future. Next slide, Ashvin, please. Now, if Tej, you can take the financials.
Sure, sir. Thank you. So Aavas, what it has done over the past 4-5 years is it has focused on whatever new geography it enters into. It has focused on turnaround times rather than focusing on any specific disbursement targets or focusing on any specific AUM targets, especially for the branches or the salespeople. And with the focus on turnaround times, what it leads to is better customer service and no specific pressure on the sales team to deliver monthly numbers and disbursements, which usually puts a lot of pressure over the longer term on asset quality and leads to increase in NPAs. So this capacity that it has built with its focus on turnaround time, what it has done is average turnaround time for a loan for Aavas 3 years ago used to be around 14-15 days. That is from application to disbursement. That has come down to about a week. So they've halved the turnaround time. And this is despite the segment that they operate in, which is 10 to 12 lakh rupee ticket size. Borrowers are someone who don't have any income proof. So that requires a high physical touch. And despite that segment, they're able to disburse loans from application to disbursal. All it takes is about 7 days. On the technology front, when it comes to financial companies, where technology helps is usually 1 out of 3 things, which is reduce risk or maybe manage or understand risk better. That is one. Second is reduce friction or reduce, therefore, operating costs. And third is improve velocity, where you can, within the same amount of time, process more number of loans. And what Aavas has done is, it's with its application, it's called Aavas Mitra, that's what the Awas application is called. All loans pass through that application. It is an in-house loan management system where all loans filed by the employee pass through that system. There is no month-ending date like most NBFCs have, or like most banks have. When there is no month-ending date, what happens usually for other banks or NBFCs is it puts a lot of pressure, and say 40-50% of the loans will be booked in the last 7 days or the last 8-10 days of the month. Awas closes its book every month twice, which is on a fortnightly basis, and 25% of the loans are booked every week. So there is no month-end pressure. There is no disbursal in the last 10 days or the 15 or the last week of the month. Second is, what Awas does is they not only start collecting once the due date comes in. So there is a collection effort which goes also before the due date is due. So once, say, an EMI is due on the 30th of the month, they, from their analytics and prediction model, know which are the top 10% of borrowers to focus on, where they need to start pushing and they need to start reminding them of the EMI even 10 to 15 days before the due date. So as a result of that, a very small proportion of the EMI goes in the 90 plus day bucket, resulting in much lower NPAs than most other housing finance companies or most other NBFCs. In terms of new segment addition or new addition in terms of geographies, what they've done is they add 3 new states every 5 years. So Awas enters 3 new states every 5 years, and the addition in terms of branches or deepening of the existing geographies keeps continuing. So say, for example, they started out in Rajasthan and Gujarat. They've been there for a long period of time. The deepening of presence within these existing states keeps continuing. And every 5 years, 3 new states are added, where they start off with 5 to 10 branches, and over a period of time, based on their experience, they start scaling up those branches. So over the past 3 years, again, they've added 3 new states. They've entered into 3 new geographies. They're expanding their branch network over there, and the expansion and the deepening within the existing states of Rajasthan, Gujarat, Maharashtra, Madhya Pradesh, and that continues. Coming to Cholamandalam now. What they've done on the technology side, this is recent, last few days. What they've done is they've first of all made one acquisition of a company called PaySwift, which provides payment solutions to SMEs. It also provides POS machines and supply chain financing to SMEs. Given Chola already does loan against property and other secured loans for SMEs, they'll be using PaySwift technologies to further expand their SME offering. So they'll be entering 3 new areas using PaySwift. One is SME financing, second is supply chain financing, and third is secured consumer loans. Using this acquisition, they are also going to build up on the existing SME ecosystem which they already have. And they're largely going to do secured lending. They already have, unlike a lot of other fintech players who do not have a physical collection force, Chola already has a pan-India presence when it comes to physical collection force. So it will tie in well with the technology capabilities that the PaySwift Technologies team already have built. Coming to ICICI Lombard, they, before COVID, used to process about a third of their claims in an automated way when it comes to motor claims. That number has gone up to 80% plus through COVID. So 80% plus of motor claims are now done using technology. There is no manual intervention required. It is done through their InstaSpect application. Also during COVID, they've come up with the ICICI Lombard Healthcare app, which is called the IL Take Care app. This app has seen more than 1 million downloads in the past 12 to 18 months with good amount of engagement. What it does is that all ICICI Lombard users can file their health claims through the app. Secondly, they've also tied up with the healthcare ecosystem, and they're offering discounts when it comes to nearby pharmacy shops, when it comes to testing, whether it's wellness tests or other types of tests for all ICICI Lombard customers. So that way they're also improving engagement. On the acquisition front, they made the Bharti AXA acquisition. Being the largest private general insurance player, they've taken the lead on consolidating the market, consolidating the general insurance market. This will help them on the distribution front. After this acquisition, ICICI Lombard will be the only player which will have a tie-up with all the major private sector banks in India. So Bharti AXA had a tie-up with Axis and HDFC Bank. ICICI Lombard obviously has a tie-up with ICICI Bank. With this acquisition, they'll expand the distribution reach within the private banking space. Plus, it will also add in terms of distribution heft when it comes to motor OEMs. So ICICI Lombard is the leading motor insurer, but with the Bharti AXA acquisition, they are getting additional presence in tier 2, tier 3 cities in southern India, which they lacked earlier. On new products, they have started focusing on the retail health business. Their market share, overall market share is around 7-8%. However, the retail health market share used to be around 3.5-4%. Now, with this ICICI Lombard application, and with other initiatives that they have taken on the retail health front, say for example, recruiting about 1,000 employees specifically for health insurance, they're trying to ramp up their presence in the health insurance market. That's the fastest growing part of the general insurance space. The market itself is growing at 25%. And with this expansion, they'll also start growing their top line, which earlier used to grow at 13-14% with a 20% plus EPS compounding. Their top line will also not now, with the health insurance addition to the product segment, will also start growing at a more quicker rate. Ashwin, you can go on to the next slide.
Sudhanshu?
Over to you, Sudhanshu.
Yeah, thanks. Yeah. So Galaxy Surfactant is India's leading surfactant manufacturer. It started its operation by producing the basic surfactant, which impart cleansing and foaming properties to home and personal care products. But over its existence, it has evolved a product portfolio of more than 200 plus products. The recent product portfolio additions are more into specialty care segment, which impart very specific property to the end product. In the last 3 years, company has continuously added capacities at all its manufacturing plants, except for US, and has increased the capacity by 20%. These include a blend of both performance surfactant capacities and specialty care product capacity. In terms of technology, in the last 3 years, company has acquired 20 new patents, which are given to it across geographies, be it in India, be it US, EU. The patents pertain not only to increasing the product portfolio, but also for the processes that it uses to manufacture those products. Say, for an example, chlorination patent that it has obtained, it helps company basically use the same catalyst again and again, which basically reduce the cost of manufacturing. At the same time, it also removes the need of purifying the end product, which reduces the cost and the energy requirement for the same process. So that helps the company in reducing the cost for the production and increasing its margin. In the last 3 years, again, company has, basis the patents and its R&D, has added specialty care portfolio to its specialty care portfolio, which basically are high-end use surfactants. Say, for an example, a milder surfactant, which is softer on the skin, which has a conditioning property in it. So these kind of products is what company has added, and these are driving the margins for the company. Ashwin, you can take alkyl.
Yeah. So I'll quickly cover the last 3 stocks. So on alkyl, alkyl beauty is that they reinvest a lot of capital back into the business. So 65 to 70% over the last decade, they have continued on that journey. So they have put up a new facility at Dahej. This is all greenfield. So, but besides increasing the capacity, what Dahej also gives is a lot of de-risking to alkyl. So both its plants were in the state of Maharashtra. Now Dahej is in a new state, and this is very important in especially in the chemical space, from a sustainability angle. You now have spread out manufacturing facilities, and also from a product perspective. Earlier. Say its major products, acetonitrile, used to be manufactured fully in one plant. Ethylamines used to be manufactured in Pune, and methylamines in Patalganga. Now, all these products are also kind of manufactured at least 2 places. So that is from a product side also there is a de-risking which has happened significantly. And the acetonitrile, which was a very small product for alkyl, say until 5 years back, that has really taken off significantly. Thanks to that, it has proved a more sustainable, cleaner product compared to the traditional the acetonitrile, which used to be manufactured to the traditional route. So I'll not go into technical depth, but acetonitrile, I think it contributes meaningfully now to the profits of alkyl amines. And given that nobody has been so far able to scale up, at least in India, through the acetic acid route, I think there is a long headroom for growth for alkyl in the acetonitrile space. And finally, on the technology side, while they continue to add work on the product, adding new products every year, there are 4 to 5 products which is added to the library. While they may not be contributing significantly, but definitely something like acetonitrile, after a decade, these products really scale up significantly. That has continued in the last 3 years. But more importantly, alkyl continues to also work on its engineering. This is one thing I think it's not fully understood for alkyl amines. The engineering is also an important part of their R&D team. Not only it helps in the project execution, commissioning the projects on time, but also significantly on debottlenecking. If you are not wrong, I think historically alkyl has been able to debottleneck as much as 4 to 5x of the initial installed capacity, and I think that has contributed significantly to its free cash flow growth. And also, I think one thing the company is really working now is on the catalyst front. I think if it get this right, there could be a quantum jump in the yield and the productivity of the company. So clearly, it takes on all the boxes. Coming to Suprajit, again, Suprajit, whilst its core cable business is not susceptible to disruption from the electric vehicle business, it has actually now established a tech center where it is actually trying to benefit if the electric vehicles come in. So as a result, it's working on developing products, especially in the electronics space, like it has recently developed digital instrument clusters. Similarly, it has tried to develop a product in the adjacencies of the cables, like the gear shifters and so on. And these new products, it has also got very good orders. It had actually had a press release where nearly 100 crores of orders has been. So this is nearly 7-8% of the current top line of the company. So clearly, the new products, it is working, and we are seeing initial proof of success in that front. Recently, it made a very big, significant acquisition, Kongsberg's light duty cable, which is based out of Europe. And this actually makes arguably Suprajit the largest automotive cable manufacturer in the world. And as because of the COVID, one thing is happening is that because of the COVID and because of the challenges surrounding logistics, now also the players are preferring the regional or the local presence, of the suppliers, auto component suppliers. And this acquisition actually helps, having a local presence in Europe. And it was actually got it at a very good valuation. So at 4x EBITDA, which is quite attractive. So this is a big development. Otherwise, I think normally they continue to add plants. I think one of the beauty of Suprajit is that it has within India, it has presence plant across all the major automobile hubs. And recently it has made new plants in Karnataka. So again, on the domestic manufacturing footprint continues to expand. And coming to Endurance, again, I think Endurance for the last around a decade or 15 years back, majority of its revenue used to come from the aluminum casting business. It has really scaled up very well in the new segments like suspension, braking, and transmission. And recently it has added another feather in the cap. It has actually made a foray into anti-braking system. This is the most complex product within its portfolio. Right now, the anti-braking system market in India is dominated by MNCs, both Bosch and Continental. And Endurance has been able to, through its tie-up with BWI, it has been able to build an anti-braking system at a significantly lower cost compared to what the MNCs would be offering. And we are very hopeful of significant headroom that could be made by Endurance in the anti-braking system. And also it has acquired its previous technological providers, Adler and Grimeca Brakes, and this also gives an opportunity to Endurance to go into premium bikes, basically cover suspension, braking, transmission into the premium bikes. And as the Indian market, we are seeing it slowly and surely shifting towards premium bikes. So this acquisition actually gives a lot of advantage to Endurance. I think, yeah, and they have acquired one company called Fon Press Metal in Italy. They have got very good orders for the hybrid and electric vehicles from the likes of Volkswagen Group, which also includes Audi. And I think somebody has asked a question, there is a kind of capex which has been incurred by the company to make in the European subsidiaries for making castings for this. The revenue is still not generated. They have got orders, but the capex has been incurred already. And I think as a result, you will find that Endurance free cash flow is kind of a little bit suppressed in the last 3 years. But basis these developments, we are very hopeful that it will continue to outperform the automotive industry in the coming years. I think given the paucity of the time, I think maybe this is just how we establish the longevity of the cash flows. I think is
there any slide, Ashwin, showing performance? Let's go to that and then let's start taking questions.
Yeah, so this is the stock-wise attribution. This is till 31st December. So I think if you look at the last column, you'll find that most of this is cumulative return. So as till 31st December, most of the stocks have contributed positively to the returns. So I think this kind of corroborates the stock selection process, this slide. Though the actual return is lower because of the cash drags, because of the expenses, and because of the timing, which is actually cash drag. But largely, this slide, which is a stock-wise attribution, kind of reinforces that the stock selection, we are on the right path as far as the stock selection is concerned for the portfolio.
So I think in the interest of time, because Rakshit and Salil, I think have to head off in 10 minutes. Let's get their questions out of the way. So Rakshit, first to you. So inevitable question on why is Relaxo here, but not in CCP? And the second question is one of the clients is seeking some comfort on how will Dr. Lal Path Labs grow over the next 10 years? How will it retain its moat and grow, asks Anand Sivaguru. So Relaxo and Dr. Lal for you, Rakshit.
Sure. So Relaxo, it's not, the answer is more related to what happened in CCP rather than why is it here. Relaxo has been part of our coverage, and we've really appreciated the quality of the business that has been built here at Relaxo over all these years. In CCP, we had 14 stocks when Relaxo was part of it, and TCS, Tata Consultancy Services, went through an upgrade in our internal research frameworks. And instead of having every such upgrade when it has to get added to the portfolio, instead of that addition leading to an increase in the list of stocks in the portfolio, in order to maintain the concentration in the portfolio, we go through these switches, right? So Relaxo, as a result, had been replaced by TCS because TCS got upgraded and it deserved an entry into CCP, but we wanted to maintain the concentration of the portfolio. Nothing has changed by means of our conviction levels on various aspects of Relaxo pre and post the CCP churn, and hence, since nothing has changed, wherever else Relaxo had been or had to be, there's no impact of the CCP churn on other portfolios, is position sizing or stock selection vis-a-vis Relaxo. So that's on Relaxo. Coming to Dr. Lal Path Labs, so over the next 10 years, the way we see the whole industry of diagnostic space evolving is today only 15% of the entire industry is controlled by organized pan-India players. The remaining 85% is either in the hands of government laboratories, which are a little less than 50%, and the rest being mom and pop shops owned by sort of private setups, which are sort of one lab or two lab at max type of regional setups. The way we see the industry evolving is this 15% will become a much larger proportion of the overall industry over the next 10 years through acquisition of market share and hence more consolidation by the larger and better quality players. Now, Dr. Lal PathLabs is going to play this consolidation in two different ways at the same time. One is by getting into partnerships with these mom and pop labs, right? So if there's a small lab in, let's say, a tier 2, tier 3 city of the country, Dr. Lal PathLabs will go to the lab and give an attractive proposition where the lab gets to improve its servicing of its customers without Dr. Lal disrupting the relationship that the lab has with its customers and the local medical fraternity. Dr. Lal will be providing value adds to an existing a small player through these partnerships, and a wider menu of testing as well, right? So that's one piece. The second piece is through acquisitions. These acquisitions will be bolt-ons, some of them. They've already done Suburban, and Suburban, as it goes through improvement in efficiencies of the acquired asset, right? That itself will throw out a lot of growth in free cash flow. On top, there will be network expansion in areas where organic expansion can be achieved after some inorganic has already been done, so on and so forth, right? So that's the growth runway. The main forte of or the main competitive advantage will remain around shorter turnaround times, better customer interface and experience, and also home sample collection infrastructure being set up in smaller cities, which brings in more efficiencies to the whole proposition for a customer. So that's the way we see the business growing in the next 10 years.
Thanks, Rakshit. Salil, a bunch of questions on InfoEdge. We don't have time to take all of them, but let me put two interesting questions on InfoEdge that have come. So Sanjeev Agarwal asks a beautiful question. He says that look, InfoEdge is spending labor cost, as he puts it, in building UI, UX. They're building new features. I presume he's referring to the various InfoEdge propositions, Naukri, and so on. So he says, "Ye sab jo kharcha ho raha hai, this is long-term asset creation. So why is it considered to be OPEX rather than CAPEX?" asks Sanjeev Agarwal. So your thoughts on that? And Praveen Kumar is asking, LinkedIn ka kya hoga? Isn't LinkedIn huge competition for Naukri? Ask Praveen Kumar. Salil.
Right. Yeah, great questions. In fact, the one from Sanjeev Agarwal. So, this is actually a feature which is now emerging throughout the world, right? A lot of expenses. Let's say if you're improving the website, right? You just need a good engineer, a good coder to design it, to code it, and make it better. Like his salary is obviously going to go through the P&L because you can't quantify eventually what, say, one individual or 5 individuals contributed to creating an asset which might last longer than 12 months. That apart, the fact also remains that the need to change this is the intensity is so high that you need to keep changing. You keep doing something new to keep retain your competitive edge. So these assets, which earlier we understood would give you benefits for 12 months, 15 months, 18 months, is not really the case. You are doing multiple versions of the website in a 12-month period, right? Maybe even in a 3, 4, 6-month period. So that is why they best go through the P&L and not through the balance sheet. We are not creating long-term assets by the very nature of the expenses that we are incurring, and more importantly, the very nature of the output that we are looking for from these investments. So I hope that answers the question. On the LinkedIn versus Naukri competition, yes, LinkedIn is emerging as a very preferred alternative, but LinkedIn is still very, very niche, mostly for senior. In fact, it's a mid-senior to pretty senior level of experiences where LinkedIn works, because you're looking at referrals, you're looking at networks, connections, and so on. But for the mass recruitment, for bulk of the recruitment, if you're looking to add, let's say, somebody in your back office, you don't go to LinkedIn, right? You still prefer Naukri, because the quality of resumes, the database, the sheer number of options that you'll have on Naukri is unbeatable. So LinkedIn will probably take a slot in senior management. Anyway, that's not a segment where Naukri operates. So Naukri operates at the, say, entry to kind of mid level, little bit to senior level with IM jobs acquisition that I've done, and then LinkedIn goes slightly above that. So we don't really see that as a serious competitive pressure.
And Salil, why is InfoEdge, another question, why is InfoEdge not in CCP? It's here in RG, to CCP mein kyun nahi hai?
Maybe Rakshit can also chip in here. So CCP, the objective of CCP is very, very different, right? Here in RG, again, the objective, the purpose is very different. InfoEdge, where we're looking at, a lot of businesses that they're investing in are not necessarily, not all of them are translating into, say, a long-term compounding engines. And whatever they are still financial investment. That is where bulk of the value creation is happening. The core business is doing well, right? Our worry is just about, I would not say worry, but our the portfolio selection or fitment really depends on where that incremental investments are going in. So we feel RG is a better fit for that. Rakshit, anything you want to comment on?
Yeah, so I'll give a bit of a color on the broader decision-making process, which I think people asking these questions should understand. Portfolio construction is not just stock selection; it's much beyond that, right? There's a philosophy which works. There's a portfolio concentration as a science which has to work, position sizing as a science which has to work, right? And two different portfolios, they should be different only if their objectives are different. If their end objectives are different, then the same stock can be in both serving different purposes, or one stock can be excluded from one portfolio and get included in another portfolio because it serves the purpose of one, it doesn't serve the purpose of the other. Now, what is this purpose really? The objective that Salil is talking about, it is an interplay of different types of risks and rewards that a business can offer. So those of you who are aware of our longevity framework, that framework is composed of several granular attributes around moats, capital allocation, and succession that we expect to see in a particular company. Different companies score differently on these characteristics, and then there is a CCP has a different interplay of the characteristics to define which stock enters into CCP and how much position size it gets, and RG, KCP, LCP, all of the other portfolios also have their different specific interplays. Right, so don't think of a portfolio as just stock selection. That if this company is good, it is getting selected in this particular portfolio, then it should form part of all the portfolios of a manufacturer manufacturing via a certain research process.
Okay, thanks, Rakshit. So we'll move on to Tej now. I appreciate that Rakshit and Salil, you have to head off for another call. So Tej, lovely question coming in. So an anonymous attendee is asking that, look, free cash flow to equity can be used, free cash flow analysis can be used to value manufacturing companies. But what do you do for financial services companies, since you can't use free cash flow analysis there? How do you look at those, how do you look at those, Tej?
Sure. So yes, there is no free cash flow to assess for financial companies. Because first of all, everything gets, for most of these financial companies, gets reinvested into the business. If you were to look at the free cash flow or the cash flow statement of a financial company, you would see that it would largely show negative cash flow generation, because there will be loans repaid and then there will be loans given out. Similarly, for an insurance company. Therefore, the way to look at a financial company is, just like we've shown that for CCP or for RG, if you were to take a 5-year view or a 10-year view, share price compounding is equal to free cash flow compounding for these non-financial companies. Similarly, for financial companies, we've shown in one of our KCB newsletters, book value per share or EPS compounding is equal to share price compounding over a longer period of time. So yes, there is no free cash flow or free cash flow compounding to look at. But if you were to look at financial companies, which high quality financial companies with a longer history or time period, you'll see that their book value per share and EPS compounding are equal to the share price compounding. So say HDFC Bank, last 5 years or 10 years is 20% in terms of EPS compounding. So is their share price. Similarly, for Kotak Bank, it's I think around 22-23% EPS compounding. So is their share price compounding.
Fantastic. So Kiev Fernandez asks a couple of questions about insurance companies. So the first question is, he says that, look, if the reinsurance premium increases, by say 40-50%, are the insurers able to pass it on to their customers? Are they able to pass on the cost entirely? And then the second question he asks, I guess the second question is in the context of ILOM. He says that when I buy car insurance, I look for the lowest premium, right? Then after damage, so say I guess Kiev is saying after he has an accident, the premium goes up. But then he says I'm able to switch insurance companies with lower premium. So his conclusion is that car insurers, motor insurers don't have a moat. What do you think, Pete? So one, on reinsurance premium, can it be passed on if there's a hike in that? And second, when a customer has an accident and then he switches to avoid the hike in the premium, what does that suggest? Does it suggest weak moats on the part of motor insurers?
Sure. So reinsurance premium usually is not passed on immediately, depending on how much of an increase and what the competitive intensity is. It's first of all usually passed off partially, because all insurance companies are impacted usually by a reinsurance hike. And then over a period of time, it's fully passed on. So for example, we've recently seen in the fire insurance segment that there was a reinsurance hike. So in that segment, because the consumers or the customers in that segment are corporates, all insurance companies were able to completely pass on the hike. And therefore, they were able to make really good loss ratios over the past 2-3 years and really good ROEs on that segment. However, where say it's a direct-to-consumer segment, in life insurance, for example, we are seeing reinsurance reinsurers hike premiums over the past year because of increased claims due to COVID. Over there, different companies have taken a different stance. For example, some of the companies have completely passed on the hike to consumers. Some of them have not completely passed it on. They've taken a hit of half of the premium hike and they've passed on the remaining half. However, over a period of time, these companies fully pass on the hike to the end consumer. Coming to pricing, think of it in the case of financial services, just to simplify, say the discussion, think of say banks or NBFCs. Yes, the bank or NBFC which offers the lowest interest rate can over a 1 year, 2 year period maybe increase market share. So in that sense, say if SBI is offering home loans at 6.5%, then most consumers say would have the option of taking that loan from SBI. However, that does not mean that SBI would have the best return on equity, and over a period of time, SBI will therefore be able to compound your share price the best. The key is around selection of risk, management of risk, underwriting, and therefore in the case of say ICICI Lombard, yes, they operate in a competitive industry. There are other players who will be able to there are digital players who will be able to offer the same insurance policy at a lower rate. A lot of consumers can opt for that. It is great for the customer. However, as a shareholder, go for the company which is able to manage that risk better over a longer period of time. So just like in the case of banks and NBFCs, the cost of funds for different companies would be lower. Risk selection, risk management for different companies would be lower. Similarly, say in the case of ICICI Lombard, over the past 10 years, while their profits have grown at 22-23%, on a CAGR basis, their employee cost or costs in absolute terms have grown only at a 8-9% CAGR. So the technology initiatives, the benefits of technology that we discussed earlier, they've helped ICICI Lombard to manage expenses, to keep costs low, and they've also been able to select risks better, which is exhibited by their return ratios and combined ratio.
Okay, thanks. So folks, there's several of you who are asking us these pair-wise comparison questions, right? So आप लोग पूछ रहे हो Bata versus Relaxo, कोई पूछ रहा है HLE Glasscoat versus GMM, somebody else is asking Tata Elxsi versus LTTS. So my strong suggestion to you guys, right? It's your money, it's your portfolio. So I suspect you're asking us effectively for a stock tip. My strong suggestion is don't do this sort of pair-wise comparison. It doesn't get you anywhere, right? So as you know, in several portfolios, we sometimes hold multiple companies from the same sector. So in CCP, we hold Asian and Berger. In this portfolio, in Rising Giants, we hold multiple NBFCs, and CCP, we hold multiple banks, right? Indeed, Tej runs a portfolio entirely made up of financial services companies. Why do we do that? Why do we not spend our time doing these futile pairwise comparisons? Because it's entirely possible that in the same industry, you'll have two outstanding compounders, right? So these pairwise comparisons get you nowhere. What you need to do is, if you want to keep it short and simple, if you don't want to do research yourself, you need to hire a registered investment advisor. So go to the SEBI website. I think there are 1,200 RIAs, email addresses, phone numbers given. Find a good RIA who can help advise you on how to do stock picking, because pairwise stock comparison is the most futile exercise. This is a country where there are so many sectors. We discussed it at the beginning of the session. So many sectors where 85-90% of the sector is unorganized. It is highly possible, indeed inevitable, that there'll be multiple great compounders in the path lab sector, for example, in the footwear sector, for example, in the undergarment sector. So if you spend your whole life doing these pairwise comparisons, you sort of you miss the wood from the trees. Now, if you don't want to hire an RIA, you don't want to hire an investment advisor, then at the very least, read the last couple of years of annual reports and try to understand what is the, as Ashwin highlighted, what is the return on capital of these companies. In Diamonds in the Dust, we've shown you how return on capital can be calculated. It's a straightforward metric that you can calculate. And if you can see that you have multiple companies in that same sector with ROCs well above 15%, and then you go to the cash flow statement, you can see you've got multiple companies in the same sector with free cash flow. Free cash flow can be calculated. Again, we've shown in Diamonds in the Dust how you can do that. Operating cash flow plus investing cash flow gives you free cash flow. So good ROC, good free cash flow, and you can see that the companies are growing well. You might well end up investing in multiple companies in the same sector. So by all means, ask whoever you want these pairwise comparison questions: HLE versus GMM, Relaxo versus Bata, Tata Elxsi versus LTTS. But my suggestion to you is you're not going to get very far with that sort of thinking. Now, some of you are asking about the RG portfolio. Folks, the RG portfolio is what we showed you. So we showed you the entire RG portfolio. So if you're an investor in RG, the RG portfolio has been shown. The specific weights of each stock will come to you with your statement, with your Rising Giants PMS statement, or if you're in Rising Giants EIF, the specific weights of each stock in RG will come to you if an investor. You'll have a username and password. You log into our website, you'll get that, and that way you'll have the names of the stocks, which Ashwin has already disclosed in the PowerPoint. The entire portfolio has been disclosed to you in this Zoom webinar. The weights will be disclosed only to the clients. Several of you are asking, what's the difference between CCP, Rising Giants, Little Champs, Kings of Capital? I'll try to summarize the difference between various portfolios. Ashwin, can we go to that वो वाला slide जहाँ पे आपने Rising Giants का free cash flow दिखाया, first few years, second few years, right? No, the quantitative, where you showed 3 different phases, the numbers on free cash flow compounding. इससे पहले जाइए.
think there is
before this. This one. Just stop there. So folks, as you've probably heard us say in hundreds of webinars, CCP, our flagship product with roughly 8,000 crores now in it. CCP companies grow their free cash flows at 25%, right? Last 10 years, last 15 years, last 5 years, CCP companies grow their free cash flows at 25%. The typical CCP company's market cap is 1,80,000 crores, very stable compounders. And guess what? CCP companies' share price compounding last 3 years has been 25-26%, right? So free cash flow compounding आपका 25%, आपका share price compounding CCP का 25%, right? Rising giants companies, if you take a blend of say FY15 to FY20, Ashwin has broken it up into FY15 to 18 and 18 to 21. If you blend the rising giants companies ka last 5 years ka free cash flow, it's around the 30% mark, right? And therefore, rising giants companies, the share price compounding can only be commensurate to free cash flow growth. Share price compounding doesn't come from, as we've discussed all this afternoon, share price compounding doesn't come from PE multiples. It doesn't come from GDP growth. Share price compounding comes from free cash flow growth. So whereas the CCP company's typical market cap is 1,70,000 crore, 1,70,000 crores, a typical rising giants company's market cap is 30,000 crores, and the free cash flow compounding, thus the likely compounding of the portfolio is likely to be in the vicinity of 30%, right? So CCP 25 ke aspas, RG 30 ke aspas, and Little Champs, as you guys have seen over the last 3 years, the Little Champs portfolio's compounding is around, right? So you have 3 very distinctive portfolios. Little Champs portfolio typical stock ka market cap is 5,000 crores. So Little Champs 5,000 crores market cap, around 40% compounding mila hai last 3 years mein. RG market cap around 30,000 crores, free cash flow compounding you can see around 30%, and CCP market cap giant, right, 1,70,000 crores, compounding around 25%, right? So 3 very distinctive products. The suggestion that we have historically given you is think of it as a thali. CCP is the dal chawal, the most stable portfolio, the lowest volatility. Therefore, make that your core staple dish. That's your carbohydrates taken care of. Rising giants is the sabjis, the vegetable dish, or if you're a non-vegetarian, the chicken dish. Slightly more volatile than CCP, but slightly better in compounding, as evidenced by the slide you're seeing as Ashwin showed you. This is the exponential growth in free cash flows. And LCP is the smallest of the lot. That's the dessert. As many of you know, we stopped taking monies for LCP in June 2020. Yeah, June 2020, we stopped taking monies for LCP. So unfortunately, if you are interested in LCP, we can't take your money, and therefore you have CCP as the large cap liquid portfolio, RG as the mid cap portfolio. We also have Kings of Capital, which is the financials product which Tej looks after. That's compounded at 25% since inception. A lot of you have asked us, why does it compound less than the bank Nifty? And as Tej has explained in several newsletters, the bank Nifty is only banks, as the name suggests. Kings of Capital is 40% banks, 60% non-banks, and therefore 25% compounding in Kings of Capital is what you should have we have expected, because the businesses, again, Kings of Capital businesses, firms like HDFC Bank, Bajaj Finance, Aavas Financiers, HDFC Life, they're growing at 20-25%, and therefore the compounding there is likely to be in that vicinity, which is solid compounding in the Indian context. So we are accepting flows in CCP, we are accepting flows in rising giants, we are accepting flows in Kings of Capital. All 3 are available in PMS format. Rising giants is also available in AIF format, but the AIF format, we only open it sporadically for inflows. On an ongoing basis, rising giants will only be open in PMS format. If you want to invest in rising giants in an AIF format, every 90 days or so, we will take money for a week or so, and then we will lock it up again. So reach out to your contact in Marcellus or to your wealth manager if you want to invest in any of these products. 3 very distinctive tiers of risk return. Subse lowest risk, lowest return in a way is CCP, slightly higher level of volatility, slightly higher level of risk, therefore RG with slightly higher level of returns. So returns are very different. Again, the data is all available on our website, right? So let's move further. Let's move on further. So Ashwin, there's a natural question that people are asking because of the phase chart you showed, right? Nascent, growth, mature, right? You just want to toggle to that chart, right? That nascent, growth, mature, right? So since we have shown that there are various stages, to companies going through these stages. When will the rising giants companies hit the mature stage? Is a question that the RG question that the anonymous attendee asked, and implicitly I think the anonymous attendee is asking you, ये mature stage कितना दूर है, और अगर hit कर गया तो what will Ashwin do?
Yeah, so we actually don't want and pray that they will hit the mature stage anytime soon, and so basically, how do we assess that companies kind of the free cash flow growth is kind of started stagnating is through a longevity framework. So whatever we showed stock wise for the last 3 years is a part of the broader longevity framework. So we keep on looking at the stock annual reports, the takeaways from the management meeting. Is the company getting lax? And is the company kind of, if the addressable market, it's natural that, you will reach a stage where you are hitting a ceiling in terms of market share or the addressable market ka saturation hota hai. But what is the company doing to kind of add new growth drivers? So I think we have written a very interesting note in consistent compounders. I think in the month of December, how consistent compounder companies keep on, whenever there is a S curve, the kind of a curve is going to bend, how do they add growth drivers and how that it keeps the curve going up and up. That is what we also do for the rising giants. So we find that company ka free cash flow stagnate ho raha hai, etc. I think it's an indication that we need to get out of the stock.
Okay. Again, one of you asked, what is free cash flow compounding for Kings of Capital? So as Tej explained in response to one of your questions, in financials, there is no concept of free cash flow. And therefore, there you're looking at basically growth in book value, or for life insurance, growth in embedded value. Over the last several years, last 3 years, 5 years, the Kings of Capital companies have been able to grow their businesses, their book value, their embedded value at between 20 to 25%. And therefore, as we come out of COVID, that's the sort of compounding you should expect from Kings of Capital, as it happens since inception in July 2020, right? July 2020, since inception in July 2020, Kings of Capital has compounded at 25%, which I think is the likely long-term compounding here. And I think that's a very solid rate of compounding from high quality financial services companies. What is the difference between an AIF format and a PMS format? So portfolio management services, PMS means every single one of you who's listening, if you open a PMS with us, that means you get your own demat account, right? So with one of our custodians, a demat account will be opened in your name. The stocks will be held in your name, in your demat account. All you are doing in a PMS is you're giving us the power of attorney to operate that account on your behalf. That's a PMS, right? An AIF is a fund. So much like a mutual fund, the only difference is AIF may, as per SEBI rules, the minimum ticket is 1 crore. An AIF is a fund, and therefore in a fund, your money, Tej's money, Ashwin's money, my money gets pooled, right? Your money leaves your bank account, comes into a pooled fund, and in the case of Rising Giants, Ashvin Shetty runs that fund, much like with a mutual fund. So in the case of an AIF, your money is no longer in your name. You've got your allocated units in the fund. You own a proportion of the fund, and as and when you want to redeem, you redeem the units. We sell the units in the we redeem your when you redeem your units. We sell the underlying stock and we give you your money back. So AIF is a separate product under SEBI's rules. PMS is a separate product. Rising Giants is available in both formats, right? The minimum for Rising Giants, regardless of whether you come through PMS or AIF, the minimum subscription is 1 crore to invest in it. In CCP and in Kings of Capital, the minimum is a 50 lakh amount. And stocks will be the same. Sandeep Cardozo asks, will the stocks be the same? Ashwin, there's no stock differences, right? Or is there one because of some SEBI rule?
No. As of now, it's similar.
So our stocks are same, Mr. Cardozo. Stocks are same between the AIF and the PMS. Okay. So again, people are asking for allocations. How much should they allocate to CCP? How much should they allocate to Rising Giants? How much to LCP? Roughly, folks, this is what we do with our monies. Vis-a-vis your own wealth allocation. I would suggest get a good RIA, get a good SEBI registered investment advisor. They don't cost a lot, and good RIAs can be very useful, both in coffee can investing and in diamonds in the dust. We've shown you how good RIAs work, how they can help you allocate your money across large cap, mid cap, small cap products. But roughly in say my case, half of my money is in CCP, right? That's my dal chawal, that's my bread and butter, so to speak. Roughly 40% of my money is in KCP and Rising Giants, and around 10% of my money is in Little Champs, right? So given my stage of life, given my risk reward at my stage of life, I've got kids going up who go to university in the next hopefully 4 or 5 years. I've got half of my wealth in Rising Giants. Sorry, half of my wealth in CCP, around 40% spread between KCP and RG, and 10% in Little Champs. However, if you are much younger than me, you might have a higher inclination to do more Rising Giants, more Kings of Capital. And if you're older than me, maybe it's a different question altogether. On the other hand, if you're a very rich 60-year-old, right, and you've got lots of money in the bank and no obvious need, your kids have grown up, they're doing well for themselves, then again your risk profile should be much higher. So just because I'm older because you are older than me doesn't mean you have a lower risk profile. If you're older and you've got lots of money in the bank and no massive financial commitments on your head, you can put more money in higher risk, higher return products. And this is why I keep telling people, get a good registered investment advisor who can help you with this allocation. Ashwin, question being asked by anonymous attendee: does free cash flow increase always correlate with stock price increase?
Yes, I think it should. Actually, that was the whole point of today's presentation. So
that's actually a beautiful question. So let's do justice to this. This is, I think, in a way, the heart of it. I've been doing this for the best part of 20 years, and I haven't found stocks which have gunned out good, solid free cash flow over 3-4 years without seeing stock price action. Nahi hota hai, because these are markets are reasonably efficient. So if you have a company doing solid free cash flow generation, people like us and thousands of people like us across the world, across India, are paid to lock into those and make money from it. So I know you keep, it's the sort of the typical kind of fear that people try to instill in you, that high PE में लोगे तो फिर खत्म हो जाएगा, market crash हो जाएगा, PE फट जाएगा, Infosys का share price 2008 में वही था जो 2000 में था, right? So you keep hearing stuff like that, but a simple way to demystify all of it is, if companies' free cash flows grow, their share price grows. So if you go back and look at the Infosys annual report, 2000 and 2008, look at the free cash flows and you'll get your answer on why the share prices didn't move. Companies where free cash flow compounding comes through nicely, you get your reward as an investor. The problem is 90% of stocks in India don't have free cash flow in the first place, let alone free cash flow compounding, which is why you see a lot of this PE-based investing in our country, because a lot of people in our country, they don't know what to do. So they use PE multiples and they invest in companies without free cash flow. In fact, the majority of Nifty companies don't have any free cash flow. So Ashwin showing you exponential free cash flow growth. The majority of Nifty companies के पास एक रुपया भी free cash flow नहीं है. They haven't had it in the last year. They haven't had it in the last 10 years. They haven't had it in the last 15 years. And that gives you a sense of how messed up investing can be. You have the benchmark index, Sensex or Nifty. Majority of companies actually don't generate any any free cash flow at all. Amit Khanna says your portfolios are underperforming across the board. Any view? So Amit, that's the idea. We have our focus is on maintaining your downside risk. Our focus is not on chasing the index. We are very happy there's a bull market, but we've always insisted that we will not chase bull markets. And if you look across the world, look at fund managers like us, the way our portfolios work is in a bull market, we'll trail the market by 5-10% quite happily actually. Why? Because if you build portfolios like this, when the market tanks on you, and it will tank, I guarantee you the Indian market will tank. It's tanked before, it's tanked, it will tank in future. So every stock market will go through cycles. Our portfolios fall half as much as the market. So for example, Jan, Feb, March 2020, the stock market fell 30%, Little Champs fell 15%, CCP fell 13%, right? And our job is to protect your wealth under duress. In a bull market, everybody is a hero. The auto rickshaw driver outside, he's got a strong portfolio outside. I'm not making it up. In bull market, everybody is a hero. Our job is not to try to be a hero in a bull market. You want heroes in a bull market, find somebody else to look after your money. Our job is to protect your wealth so that in a bull market, we will trail. And then when there's a blow up, and there will be a blow up in our country, वो election की वजह से होगा, या Federal Reserve tightening की वजह से होगा, or as is inevitable, 2 or 3 fraud banks will blow up. Your money will be wiped out if you go with a hero. In our sort of portfolios, given the research that's been presented to you today and over the last 3 years, when the market corrects by say 30%, your portfolio should be correcting half as much. And that protection of the downside risk will almost guarantee you outperformance on a cross-cycle basis. So if you want, actually I'll give you a simple nostrum, which will mean that your portfolio will never underperform, which is you should buy an ETF. So buy a BSE small cap ETF, buy a Nifty ETF, buy Nifty banks. You'll never outperform, you'll never underperform, right? You will perpetually have index performance, but that will then expose you to what typically happens in a drawdown. In a stress case scenario, the Nifty will correct or Nifty banks will correct. And that's when you might remember, why does Marcellus build high quality portfolios which underperform in a bull market? It's very easy to outperform in a bull market. There's a bunch of tricks that we could happily use, but it's unethical to do so. And it also exposes you and our 10,000 clients to downside risk. Our main job is to protect your wealth rather than to look like heroes in a bull market. Rupin Merchant asks, Ashwin, I'll put this to you. Rupin Merchant asks, what about some companies with very high PE? Is it still attractive to invest in them at this point? So do you want to use your framework, Ashwin, to explain to Rupin Merchant why PE is not relevant?
Yeah.
Ashwin, you there? Ashwin, can you hear us? I think his line might have got disconnected. Okay, so let me try to clarify. So Rupin, what Ashwin's tried to show you is what drives stock prices is free cash flows, right? Free cash flows drive stock prices, not the E. Ashwin, can you hear us? I think we've lost him. So what drives stock prices is not free cash flow. Is not earnings, I'm sorry, it's free cash flow. Rakshit showed you the same thing in the November CCP webinar, that share price compounding is driven by free cash flow, not by earnings, right? Now, what Ashwin then further showed in this session and Rakshit showed in November for CCP is, if you invest in high quality companies, their free cash flow compounds much faster than their earnings. So Ashwin gave a case study today of Astral Poly, where over the last 10 years, profits have grown 5x, but free cash flow has grown 100x, right? Profits have grown 5x, free cash flow has grown 100x, and unsurprisingly, Astral share price has grown with free cash flow, not with earnings. Now, a typical fund manager in our country will say, "Arey, dekho, Astral ka PE बढ़ गया." But if you look at Astral ka price by free cash flow, it hasn't gone up. Astral share price and free cash flow have moved in sync. So it's one of the simplest aspects of finance. In fact, finance 101 is DCF analysis करके company को value करो, right? No finance professor says profits को discount करो, right? Every finance professor, right, even the most rudimentary BCom में आपको सिखाया जाता है cash flow को discount करो. Why do they say that? Because cash flow drives valuation. And Ashwin gave you a case study in this webinar about how over the last decade, Astral's profits have gone up 5x, but free cash flow has gone up 100x. And that 100x growth in free cash flow has been central to driving Astral's share price up by 200x over 10 years. And that really is our job across various portfolios, right? Earnings is not what drives. Earnings is not what drives wealth compounding. And across our portfolios, whether it is Little Champs, whether it is Rising Giants, whether it is CCP, share prices and free cash flow compounding are moving in sync. And because free cash flows are growing faster than profits, again, Ashwin showed you why. Why does that happen? Why do free cash flows grow faster than profits? Because as companies pass a certain stage in development, their reinvestment requirements reduce, their working capital cycle shrinks, right? As their working capital cycle shrinks, as their asset turns improve, the cash drag from reinvestment reduces. And as a result, free cash flows grow much faster than profits. Optically, it makes the PE look high, but that PE being high is irrelevant to the discourse. What you, I, and everybody listening to us has to focus on is free cash flows. Free cash flows need a little bit more work to figure out, but that's where a good analyst, a good fund manager comes into picture. Folks, we'll call it a day here today. I think we've answered the crux of your questions about the difference in various products. Our view is that given the stage of India's economic development, these sorts of companies and the market cap range from $500 million through to $10 billion have a tremendous 4-5 years ahead of them. All my colleagues told you about how they're investing. These companies are investing in technology, in capacity, in distribution footprint, in acquisitions. All of that mehnat that these companies are doing, all of that hard work, all of that investments will bear fruit over the next 2, 3, 4 years. And we're looking forward to profiting from that in the Rising Giants portfolios. We hope you can join us for this journey. We will put this webinar and the slides on our website. So if you want to watch it again, feel free to watch it again on our website. Thank you for joining us this evening. Thanks a lot.
Thank you.
Thank you.